everyone, welcome. Today we are talking about the nuances and the issues around fundraising. Hey, it's a zany marketplace out there. It's hard, but if you know the ropes, guess what? You have a good chance of getting that important financing runway. I am Jean Sullivan, and I'm part of the Arcview team. But my best credential that I can tell you is I have seen, reviewed, and been part of so many companies. In fact, I am sure I've seen 1,000 times 1,000 companies in my investing life in all stages. That's a million, and I'll bet you that's close to the number. And certainly thousands and thousands of cannabis companies. So I know how hard it is, and that's why we're doing this Arcview Access program today. I am pleased to be introducing today's conversation. First, hey, let me give you a quick update on what Arcview is today, because we've had our own changes before, during, and after our COVID life. I am proud that the vast community that Arcview has built over the 12-year history has generated more than $300 million and invested in just about every cannabis company there is. And so that's pretty exciting. But since our COVID days and since our live event days, we have set up 3 lines of business to create even more traction for the new and well-known investors and entrepreneurs in cannabis. So I'm excited to tell you, first, Arcview Capital, which is a FINRA registered broker-dealer. It provides investment banking services, and we recently launched a crowdfunding platform. So proud of that. And today you'll be meeting Jeff Pescarella, who founded Arcview Capital. We've got Arcview Ventures. It's our principal investing group and operator of the Collective Fund, which is a member-managed venture capital fund. We have 78 active limited partner members, and it's a committed capital fund. But it's unique in that the members are quite involved in the decision making. And we just made our 19th investment, and I'm proud to say that Jeff Finkel and I manage that fund. Jeff's moderating today, and we are looking for great companies. So if you have one, send it our way. Then we've got our third fabulous group is Arcview Consulting. Look, for years, people have come to us saying, what should I do with my business? So the consulting group works with many various organizations, startups to multi-billion-dollar MSOs, help them suss through strategic initiatives, license applications, state expansion plans, valuations, M&A related services, among many other projects. So be sure to find your way to us if you need us for that. And most recently, so proud to be part of Arcview Events and Experience, which is our joint venture with McVeigh Global Media Meeting and Events Group. And Jeff, I'm so proud that you did make this happen. And it's to relaunch and create scale for our in-person events and for these digital programming events. And also, we operate the Women's Inclusion Network, which is a platform for women in the industry to network, collaborate, support each other. I am proud to be one of the founders of that group. So over the last COVID years, we have created many, many digital programming events. And before that, more than 40 in-person events over our long history. So we encourage you to keep joining us for events like this. And so pleased to tell you that our next live event is going to be in New York City, October 19th, 20th, and 21st. Really thrilled to reconvene. Now, we like to put up a survey. Fabio, go ahead and put up a survey, and that helps us know what you want. So fill it in either now or you can push it to the side and do it later. That helps us plan and come up with some great events. All right. We're just about to kick off today's very vibrant conversation, but we want to thank our alliance partners because you help us make these programs happen, and we're pleased with that and very appreciative. Incredible resources for our industry. You need banking services? Well, PayQuick is one of those partners providing full banking services to cannabis companies. You need a strong law firm? Ice Miller is here today, and one of their premier attorneys is with us today, talking about some of the very interesting issues around funding. A financial services firm, Green Growth CPA is one of our partners. You need insurance? Alpha Root, terrific company. What about payroll services and 401k services? We've had a long friendship with our friends at work. Management consulting and exec search firm, Waterton Partners, and financial consulting group, North Star. Thank you all for that. Now, to succeed at this, we like leveraging our thought leadership through these content pieces. So we want to hear from you to explore all these topics. Now, take a look too at our Arcview site. It's under arcviewgroup.com. Go ahead, Fabio, put that in the chat so people can see that. That's how you can find out about these events. All right, Jeff, over to you to kick off our program. Jeff Finkel is my terrific business partner for Arcview Ventures. He also is the CEO of the Arcview Group, doing great, making a lot of things happen for this fabulous industry. Jeff is moderating today, and over to you to introduce our terrific guests.
Thank you, Jean, and welcome everybody. I'm excited for this because, you know, fundraising is difficult and it's time consuming, and most entrepreneurs hate it. There are a select few that feel comfortable, but in my experience, that's really not the norm. It's mystifying and it needs to be demystified. That's why demystifying the fundraising process is part of the title for today's program. The other part of the title is Angels Say I'm Too Early. Entrepreneurs are generally confused by this because they naturally assume that angels always invest at the pre-seed and seed stage, but that's not the case. There's a lot of confusion around stage and investor type and planning for future rounds. And today we're going to explore this and other components of the fundraising journey that need to be clarified, or as we say, demystified. So I may pause a few times during today's program to embrace questions from the audience if they come in volume. Because again, our goal here is to demystify and sort of help you by answering these questions. Entrepreneurs should really walk away having learned something. So Danielle and Kylie, just let me know if I'm not sort of seeing all the question buildup. I will look, but just in case I'm focused on the questions, because I do want to try to address them. All right, we got great panelists today to help peel back the onion of this subject. Please join the stage, all of our panelists, and I'm going to introduce you quickly and then ask you to go a little bit deeper. First, we have Erin Gore from Garden Society and Bob Craig from PayQuick. As entrepreneurs. We have an individual investor who's a former operator in Alain Banquier. We have Jeff Pascarella from Arcview Capital, who's been involved in many fundraising mandates as a banker, and Christine Dahlman, an attorney from Ice Miller. So again, I was going to kind of go deeper on the intros, but I always find that if I let you do it, it's going to be a lot better. So I'm going to let you do it. Please try to keep it to 30 to 45 seconds apiece. Let's start with Erin Gore.
Sure. Hi, Jeff. Thanks for having me here. And hi, Jean. My name is Erin Gore. I'm the founder and CEO of Garden Society. We're a California operator, building a world-class brand. We started in the medical market. We fully transitioned through a vertical license, and now we're building national processing. We just opened our factory in Ohio last week. We're really excited about. I'm passionate about this topic because it's been very, very hard for me as a female founder. I'm proud to say Arcview's invested in me personally, and I have a lot of information to share around what I did wrong and what I would recommend everybody else does better.
Bob?
Yeah, thanks, Jeff and Jean. And I think I may have been at least 100 of those pitches that got in front of Jean. My name is Bob Craig. I'm the CEO of PayQuick. My background is traditional banking, JP Morgan, Wells Fargo. Then I went an entrepreneurial route. And I think I'm on my fourth startup here, oftentimes selling them to fintech companies. PayQuick is a national banking provider to the cannabis industry. We like to normalize operations for banking for operators in all the adult use states and a couple of medical states as well. And so I'm happy to be here and help other entrepreneurs think about how to raise money.
Thank you, Bob. Elaine?
Hi, thanks everybody, Jean, Jeff, and the whole team. So I have been, I have a little older, so I have a longer background. I started out in banking, where I was corporate finance, head of corporate finance America for BNP Paribas, and then I went on to get on the other side, that's the client side, and built up a food group where I was CEO, which I then sold to Bain. And in about 2013, I thought I was just going to spend my time doing angel investing full time. I was one of the founders of the New York Angels in the late 90s. And I got involved in the cannabis industry. That was around 2013. And I was so in love with it that I stopped all angel investing, except specifically in the cannabis industry, and got involved in operating roles and board roles. And today I'm basically still writing checks, albeit very, very carefully. And I'm involved in a couple of boards and advisor for a couple of companies.
All right, great, Jeff.
Hey, thank you for having me. I'm Jeff Pasquarello. I'm the founder of Arcview Capital. I have over 20 years experience in financial services, including 17 years with the regulator and many years as a entrepreneur myself and working to get this business going. So look forward to talking to you all.
Jeff and Christina.
It's a pleasure to be here with everyone. I'm an attorney at Ice Miller. It's a Midwest and East Coast law firm that provides full service legal services. In particular, obviously relevant here, I'm a co-founder of our firm's cannabis industry practice, and we help those interested in entering the industry through to the MSOs. And so my background in particular is litigation and risk management and compliance, which really is relevant for those newcomers, because I can help, and we generally help those plan for the future. And so working with those that are startups to MSOs, we look forward to talking with you more today.
Awesome. Thank you so much, Christina. All right, let's dive right in. Erin Gore, have you ever been told you're too early?
Every time.
Not every time.
Almost every time. No, not every time. I think the biggest mistake I learned early on is I was pitching the wrong people for the wrong stage of business. So a lot of times I was told I was too early, but then I really had to learn how to pivot what I was pitching and who I was. And I don't think being too early is actually real. I think what their investment thesis is just misaligned to the stage of business I was at. But yeah, it was a big learning curve to who to pitch to, how, when, and the whole notion of too early, especially as a woman founder, right? Because we just don't have access to the same level of capital as our male peers. And so we're always too early. I'm too early in growth now compared to other stages, right? So I think it's a nuisance question with a very, very deep conversation ahead.
All right, great. Bob, how about you? What was the hardest part of pulling together your rounds at PayQuick or even in your other companies?
Yeah, and I'd say sometimes you're too early and sometimes you're not early enough. To pile on with what Erin was saying about the right match, and it's a little bit more than Match.com or something like that. You really need to understand the check size that you're looking for, the number. Are you looking for a lead? Are you trying to find somebody who's investing specifically in your product, or are you looking for somebody who's more broadly in your industry? Or in the case of PayQuick, we're very much a fintech. So cannabis investors didn't necessarily have the same depth of understanding around banking, and that's really what our service is. It's ancillary to the industry. And then, one of the things that we started out with was looking for a little amount of money through a safe. And as we were oversubscribed in our safe, and I got some advice from very smart people, they said, listen, institutional investors are not going to like safes. And then institutional investors started saying the same thing. And so we looked into taking our round in a different direction and made it a preferred round. So it can elongate your time frame, especially the style with which people want to invest in you.
Understood. So Elaine, I'm sure you've told prospective portfolio CEOs that they're too early. So you can certainly talk about that, but how do you sort of just think about, where you like to invest sort of across the spectrum without necessarily defining stages, but you can. But where do you sort of like, what's like the characteristic of a company that sort of gets your attention?
Unpack that very, very quickly. I am early. I rarely tell people they're too early. It has happened a couple of times because they have been way too early. And usually too early doesn't really mean too early. It means not ready or not a good fit. I think the one time I had somebody that was really too early was in the cannabis industry. And it was somebody that had no idea about what they were doing. They weren't even incorporated. You know, I mean, so basically they thought that they could just be themselves and have a business. And, you know, I ended up giving them a little guidance and steering them in the right direction. But that's kind of the only real too early. Usually it's people just aren't ready. Although it's kind of rare because I'm pretty early myself. That being said, it's different industry by industry, and within the cannabis industry, it's really different sort of activity by activity, like based on what stage or what kind of business you're in. And you know, so I usually come after you've already start getting a business together. The other thing I like is I like to have a team. I don't like to invest when there's only one person. So I'm a big proponent of co-founders, and we can talk about that later if you would like more. But I usually come in when there's already the groundwork that's been laid. You know, whether it's pre-revenue or post-revenue, that's kind of case by case. But so I usually come in like around after the friends and family. Friends and family is when you have a great idea and you go out and you get the easy money, the people that believe in you, the people that know you, the people that you can get money from, so that at least there's something going on. And that's, you know, I come in a little bit after that. The other thing that I should say is that I also am a big believer in multiple rounds. So when I get in, I will usually participate as we go through when there's multiple rounds that happen.
You stay in. Okay, look, I'm going to attempt, to just put some form and function around stage and type, just to put on the table today as a thesis. And anybody comment, this is not necessarily the definition that the world ascribes to, but it is mine. So the way that I think of the world is there's pre-seed. So let's say in its non-cannabis operating context, pre-seed might be Aaron and I see that there's a need for a software product out there. Aaron understands the customer requirements really well. I'm coding at night, but we each have other jobs. So what do we know? We've identified an opportunity. We have no product out there. There's no data. I say we're a pre-seed company. The corollary for cannabis operating companies would be license pursuit, just people with a plan trying to get a license. In pre-seed, it's typical that that's a friends and family round, right? Why? There's no data. There's no data with which to make a decision. There's no usage patterns. It's a bet on me and Aaron. That to me is a pre-seed opportunity.
If I may add to like product, I think because a lot of cannabis companies are product companies, but they don't hold a license. So it's also like pre-commercialized product.
Yeah, that would.
I think that confuses people a lot.
That would certainly do it. Then I sort of see seed as the next stage. And in the seed stage, Aaron and I have now quit our jobs. Now we're coding full time. We've got this friends and family money. I'm coding full time. Aaron's knocking on doors and getting lighthouse customers. We now know something. We know about how long it takes to get a lighthouse customer. We know the usage pattern. There's data. And data can inform the next level investor, the seed investor, that's more than just me and Aaron. They may not know us, but there's now some data with which to make a decision. That to me is a seed round. The corollary in operating businesses in cannabis might be build out financing post-license grant, for example. In that situation, it's angel investors. It could be seed funds that invest. Then going up the chain, there's early growth. So to me, once we now have our seed money, now we've got some data, there's evidence that if we keep iterating what we're doing and keep refining the product and talking to more customers, getting more, we're going to eventually get to that notion called product market fit. That's the point where what we're offering meets the needs of the user and the pricing is right and the channels, and now it's ready to, it's just like Monopoly. It's time to put your hotel on Boardwalk and Park Place and invest your money for scale. And at early growth is usually where traditional Series A and traditional venture funds come into fund. Now, this is not sort of the universe, again, definition, right? After that might be the growth stage where we're a functioning business. We built the business around the product, and now we want to do product line extension, or we want to go into different region, or in the case of cannabis, we might want to expand into other states or open up new stores. So I just want to throw that out for anybody to comment as sort of a guideline about how entrepreneurs should think about it. And the other thing I want to quickly make is that angel investors can participate at any of those stages, and they often do. Some will not do pre-seed unless the angel's your uncle who knows Aaron and I, right? But professional angels will usually come in at seed or early growth, or if they're lucky enough to participate in a growth capital round. Any comments?
The only thing I'll add to it that kind of got me hung up in my fundraising journey is I tried to use those terms. Like I felt like everybody knew what a seed round was and everybody knew what a Series A round was. And what was an education for me was that they're actually just like generic terms, but they actually don't really mean anything. And then especially if you're doing a convertible or a safe note or a bridge round or all this stuff. So I think it's really important that you identify the stage of your company and think of it in that terms. But don't use those titles as it pertains to your financing, because it sounds weird when you say like, I'm pre-idea and I'm launching my Series A. Maybe that's the right thing to say, but people use the terms incorrectly and it shows you're uneducated as a founder.
Look, I just open up everyone else, but do not hang too much weight on the letter of the preferred round. I've seen Series A done at seed. I've seen Series seed deals done when the company's further along. I see short Series B rounds. I see growth capital series, but so don't get tied up on the letter, right?
So I'm going to just jump in. One thing that for me is important is something that you touched on. Is you started out by saying you're coding and Aaron is still doing it part-time. I won't invest unless the entrepreneurs are full-time. Now it can often be as a result of closing this round, we'll go full-time, but that's the stretch, right? I'll do that, but I won't invest if the entrepreneurs and the teams are not full-time. As far as the nomenclature around the rounds, I agree with Aaron and with Jeff completely. Don't title it. Investors will know what you are when they see you. And, if they want to call it something else, you can let them call it whatever they want, but don't, I see entrepreneurs telling me, we're doing our Series A. And I go, well, why is that a Series A? They don't really know. It's just that the words that they pass around. So I would just not title it and let people title it, or get input from your attorneys and your finance people. Usually people don't have finance people, but your attorneys can really be helpful in helping give things the name.
So Jeff Pescarella, you've been involved in many different issuer mandates to raise money. What are some of the mistakes that you've seen companies raising do, just in terms of just sort of thinking about the whole thing organically?
Well, there's a couple things, right? You have to understand the time, right? The time it takes to do a raise. If you say you need the money within 3 to 6 months and you're just coming to go out and launch, you're already too late, right? It takes a long time to complete a raise. You need to plan accordingly and plan ahead of time in order to make sure that you have enough runway to get that money raised. Well, too often people only come once they've already expended too much capital and then they need more. You have to plan way ahead in advance. Holding too tight to your valuation, thinking you're worth more than you really are, right? And in today's times, I think there's some questions in the chat about this. that's even more important, right? Valuations are down greatly across both cannabis and psychedelics. If you look at just the public markets, VCs are paying attention, holding their cash close, looking for the right time to come back in. They'll use that as pressure to push valuations down. You need to be able to then sustain or explain clearly why your valuation is what it is and have a data room that backs it up. Where we do a lot of work with partners or issuers is making sure that they have a data room that can sustain their valuation. And next is, I would say, do a lot of prep work. Practice, right? You have to ask yourself tough questions, have partners and other people who will ask you tough questions, so that when you get in front of investors, you already have the answers before they ask the question. And hopefully you deal with it right up front in the presentation. I'd say this industry has been extremely resilient. It's still in its early maturation, right? But to have gone through a pandemic and been deemed essential is amazing. Heading into, some people might say we're already in the recession. Will it be recession proof? I'd argue it will be, but there is going to be a need for also to demonstrate currently to investors who are going to come in that you can conserve capital, right? That you understand how to manage the cash flow, and that will make for a better presentation in this environment today.
You know, Jeff, to the first thing you said, which is waiting too long. You know, one of the things we always advise entrepreneurs to do when they raise a round, let's say they're raising a seed round, is to, one, understand the metrics that are going to pull in a Series A. Figure out from the date they're going to run out of money, 9 months before the date they're going to run out of money, 9 months before, to have those metrics met, so that they can start a fundraising effort with enough time to close it. So you have to manage to a date where you're going to have the metrics. It has to be 9 months before the date you're going to run out of money. And that's the way I think to think about the planning for subsequent rounds. Listen, while I've got you, because we sort of talked about stage and type of investors, you just launched a crowdfunding site. Tell us a little bit about where that fits in and how you think about it.
Yeah, I think too often people view crowdfunding as, you know, pre-seed or seed, right? And the great thing about crowdfunding is under US regulations, you can run a crowdfunding campaign side by side with a Reg D. And so it's a really great way, particularly if you're a consumer products company, to build grassroots support. There's a company out there called a Neurohacker Collective. It's a nutraceuticals company. If you look at how they built their business, the first 4 rounds were completely on crowdfunding. They have 17 million top line revenue today, and that's because most of their investors are also their buyers, right? And they created really strong community around their product, because now their owners, their shareholders, are also the buyers of their product. And so there are things to be thinking about from the standpoint of using crowdfunding, not in I think the sense it's been used in the past, that early round. It can be used throughout the life cycle. Reg A being the mother of all kind of crowdfunding campaigns, right? Getting into pre-IPO launch space where you can raise up to $75 million. And so I think it's a really great opportunity for people to consider.
Great. Hey, Christina, let's get you involved. You keep companies out of trouble, right? Hopefully you keep them out of trouble so you don't have to represent them when they're in trouble. First, let me ask this question. You know, with a lot of these financing docs that are online, I mean, you can just Google Series C docs, get all the latest doc sets from term sheet to shareholder agreements. I could do the same for safe notes, just go to Y Combinator. They were sort of the inventor of the safe. What do you say when entrepreneurs sort of say to you, you know, with all these online docs, like, why do I need counsel to consummate a financing? Why can't I just sort of fill it out with my accountant?
Absolutely. It's a good question for folks to ask. And I appreciate when they ask, because without asking, it means they're probably going forward with one of those online services. And ultimately, the answer is pretty simple. You pay a little bit more early on to save a lot later. The number of times I've gotten involved with cannabis companies that have run into disputes vis-a-vis either formation documentation, investment documentation, and so forth, is more often than not, unfortunately. And that can get you into a lot of trouble, particularly once you've gotten pretty far down that path you were just talking about, Jeff, and you have licenses and you're beholden to regulators, and that can really run you into trouble there. And so what we always suggest is you pay a little bit more early, find a good partner attorney who understands you're starting out and you're getting your early investments. You can negotiate out even legal terms that allow for payment later once you get investors on board. But paying a little bit early can actually pay forward significantly. And I wanted to touch on one note that Alan mentioned earlier about having co-founders. And when you have multiple people involved, right, it's good also to have that documentation so that everybody's protected in that, both yourself as well as your co-funders. And that can pay a lot further down the road as well.
Yeah, I'll make a comment about that too. I was involved with two startup situations many years ago. One was a business started by 4 guys that graduated UPenn together, like smart guys. Each of them took one of the functional positions: CEO, chief marketing officer, CTO, and head of sales. Certainly, none of them were qualified functional experts for each of those functions, but that's what they assigned themselves, and that's what they did. And this CEO was smart enough to recognize early on that these guys were probably not the successor CEO in the next round. So he did a very smart vesting program. He said, look, for founders equity, we're 25% each, so we're going to start, 5% vested right out of the gate, and the rest are going to have to vest over time because, look, quite frankly, we're probably not the right guys in these roles. So what happened going forward, CEO survived all the way through exit. One of the other founders survived, but in a lesser role, the other ones were gone, and all that equity got freed up. Now, I'll give you another situation. There's a woman in the Harvard Business School with a co-founder, started a tech company, 50-50 ownership. The tech guy was doing 3 different product ideas at the same time and with 3 different partners to see which one was going to get the financing, which was where he was going to land. They had no vesting agreement. So now she was saddled with a 50% owner who wasn't putting his time into the business, which was tremendous equity overhang, which meant very difficult. And quite frankly, it was a barrier for her to raise follow-on rounds because investors didn't want to come in with that much unproductive equity on the cap table. So pay attention to these things at the outset. Christina, while I have you, so what other areas do you see sort of early stage companies making mistakes and setting themselves up for potential risk?
So really the biggest one is documentation and having a clear plan forward and documentation concerning that plan forward with either your co-founders and your investors. That's really number one. And we talked about making pitches and so forth and presenting projections. We always advise clients and give kind of a script for them to utilize when moving forward with a pitch, making clear that these are future projections, providing some information about where the projected data came from. You want to be careful, right, with some of that because you want to keep some of that information close to your chest, as well as making clear that you've made certain assumptions when presenting those projections. And another aspect that you can do that also will make you look very sophisticated when going into particularly some of those later round pitch meetings, but to consider doing it early on is to have a very standard non-disclosure agreement. Those are very common, can be very useful in early discussions. It allows for free flow of discussions, and you can even solicit information from the potential investor on feedback on what worked and what didn't work in your presentation, and all of that would be protected under that NDA. So when you later on make future presentations, you'll have the protection of that NDA with respect to the communications as well as the data, and including those unicorn softwares that you may be working on and so forth as well.
Well, go ahead, Elaine.
I just want to add one thing to what Christina was saying, is that most companies, you don't pay for those sins until you have a happy event, which is an exit. Once you have an exit, everything that you've not done that Christina just said to do, all of a sudden, everybody goes crazy. That sales guy that you promised some warrants or options to and never got documented, or that marketing lady that you gave some stock, then she never signed the document, then everybody forgot about it. When there's an exit, when all of a sudden there's a happy day, all the sins come out of the woodwork. And the best thing you can do is exactly what Christina said. because it's tedious, but that's why a business is called an organization. That's the word, organization. And you have to document everything, or else it will, the day you're happy with an exit, it will come back to haunt you. The day you have to close the door and it's game over, you don't care.
It's so true. I'm going to stay on NDAs for 1 minute, then I'm going to answer, I think, a question in the chat to see a commonality, so I'll just address it. NDAs. Investors hate them. We have a clause in ours that basically just says, hey, we'll sign this, but recognize, we're VCs and we see a lot of deals. So the very nature of reviewing a deal that's like this doesn't mean we violate. And so my question for anybody here, I mean, for the operators, for Jeff or for Elaine, when is the right time to sign an NDA? As entrepreneurs, when do you want to ask investors to do it? I am so turned off when somebody says, here's my NDA before our phone call. If you have to send me an NDA before your phone call, let's not have a phone call.
I have a strong opinion on this as a founder. And then I'm sure this is like contrary to my lawyer on the phone, Christina, who's not my lawyer, but I'm sure she'll say something different. But honestly, an NDA will, if you request an NDA too soon, it will prohibit you from getting the meeting or being heard. And quite frankly, in cannabis anyway, I don't think any idea is that novel and protective. And it's really around execution in the team. And so even people come to me all the time for advisory roles. And I'm like, look, you're creating a product. Cool. You got to tell me what it is before I sign an NDA, because I've seen it all and I've done it all. And honestly, it's all around execution going forward. So I'll sign it when there's something there that I think is worth my effort, printing, signing it, scanning it back, because it's a headache, legal review. It's a lot to sign an NDA authentically. So I actually feel very strongly, I actually don't make any of my investors or people I'm pitching to sign an NDA until it comes to the data room. Once you want my data room, then I have an NDA and copy, because now you're looking at my financials, you're looking at my contracts, you're looking at all my true protective IP, I feel. But until that point, I'll talk to anybody about my company in my pitch form, because at the end of the day, they're investing in me because I am the operator and I'm going to kill it over every other entrepreneur they're looking at. And also, I will say, somebody called me out of the blue yesterday. I know Jeff and Jean will think this is hilarious. And they're like, hey, I'd like to invest in you. And I was like, what are you talking about? Okay, cool. Thank you so much. I'm like, what? I closed my round in November 2021. Okay. I'm like, what are you talking about? Where did you hear I'm raising capital? And they're like, oh, I got your deck dated October 2019. It crossed their path and they reached out to me. And so
I think our message board is going to light up. Please send them our way. Please send them our way.
So the decks live on into perpetuity, and people send decks around, and this NDA, you have no idea. I have no idea how this random person got a pitch deck of mine from 2019. Regardless, I'm not pursuing that legally. All I care about is my data room.
Yeah. And Bob, anyone else? How do you sort of feel about when do you?
I don't sign NDAs, full stop. The only time I have signed them is usually very far into the due diligence, where there have been some companies that have actually had patents or patent pending or different things that they thought was super proprietary and confidential. But I mean, I think that's maybe 1%. I just don't sign them. I can't even think of a time where there's been the information that we've learned going through a process has been so unique and so confidential that it makes a difference. As Aaron already knows, and I think Bob as well, is that it's all about execution. A company, I'm not going to give you the name, but a company where I was more on the operating side than on the investing side. I had a potential investor that was in heavy due diligence. I mean, myself and the team spent hours with this guy. Turns out, next thing we know, he ended up creating a company that was very similar, a variation of what we were doing. And Yeah, he was actually very successful for a while. I don't think they're still around, but the company that I was in did very well. So, it's really, really hard to protect, quote unquote, except by execution.
So I'll address a couple questions, actually two from Ramon because they're different. One is just sort of the supply and demand, VCs pulling back in cannabis. I see that actually echoed from some of the other chat comments. So you're right, there's a supply and demand imbalance right now. There's certainly less money at pre-seed, seed, and early growth. It's a little bit more at growth, but the bar is high. I think it is hard right now. I think there is a supply and demand imbalance. I don't think they've all pulled back, but they're certainly being far more discriminating. Elaine, I'm sure you're being far more discriminating in what you look at.
Well, there is a supply and demand, but it doesn't work the way you think. It's not that there's lack of money. There's a lot of money floating around. It's just, it's like you said, it's pulled back and the terms have started changing. For example, myself, I won't do a deal now without an anti-dilution clause in it. That's something that, before I always tried to get, but would be very hard. And because there was so much competition for the deals, finally, somebody would lead. Oh, I should mention, as an early stage, even an angel investor, even in deals, there's other people involved, and so there's other people that may accept better terms. But now I'll walk away from a deal if I don't have anti-dilution protection, because the environment is so cold that I don't want to be in a situation where everything is going great, but there's no money, and all of a sudden somebody comes in after me at a lower valuation. So it's a very, very tough environment right now for entrepreneurs. And you don't even have to look at, you don't have to be plugged into the private fundraising world. You can just look what's going on in the public markets with cannabis companies, and with all companies actually, to see it's not, the environment has changed. We were in a world where there was a lot of free money, and now the money's gotten very expensive.
So there seems to be some interest also in the chat about crowdfunding. One question is, Jeff, to you, how do you think about how much you have to really budget to start a crowdfunding campaign and get it going? I mean, I think we all know it's not a question of post your page and they will come, right?
Yep. So I think there's a bunch of costs people should be aware of, right? A lot of the crowdfunding sites out there won't tell you about them up front. You kind of find out about them as you're going through the process. So normally there's a technology fee for onboarding onto a platform, somewhere around $2,500 to $5,000. There's a fee for the escrow agent that's going to be hooked up to the crowdfunding deal. Again, around $1,500 to a couple thousand. There is potentially you have to file the Form C, right? That's usually not the work of the crowdfunding portal. And then therefore you're either going to do it yourself or you're going to hire an attorney to do it, or somebody like Christina, right, to help you through that process. Depending on the amount of money you want to raise, you need CPA, either certified financials or a full-on audit. So to go to the 5 million threshold, you're allowed to raise up to 5 million in crowdfunding. You need a full audit. That costs a lot of money, right? And but if you're raising $300,000, you can self-certify. If you're at, Christina can tell me if I get this wrong, but I think it's $1,070,000. That's when you have to have the certification. So between the 300 to the 1 million plus, you certify with an audit of that. Then, of course, there is the marketing aspect, right? You can do a lot through email, and we recommend that people first start email with our network and your own network to push it out. And then as that goes on, we try to work with partners that will help on SEO marketing, give deferred costs, right? As you raise your money, they'll take their fees. That is the key, is the SEO marketing, getting the eyeballs to the deal. That could be quite expensive depending on what you want to spend. So you have to budget for that.
Great. All right, shifting gears. How do you guys determine how much you're going to raise in any round? What is too much? What is too little? How do you think about it? Maybe Bob or Aaron can opine here. Maybe Elaine, you can give a comment. But what's the analysis you go through? Is it just, hey, I'm going to look at my business plan, what I need for a year, and then I'm going to add, 6 months of contingency, and that's my number? How do you think about it?
This is the golden ticket, the golden goose, right? The first thing I'll say, I advise, like I said before, I advise a lot of early stage companies, specifically women founders. And the one thing that really irks my bubble, and I hear it a lot more from women than I hear it from men, is, oh, I hired somebody to build my financial model and I hired somebody to do this. So I outsourced it. And at the end of the day, I tell these women that nobody's ever going to invest in you if you don't know your business enough to be able to understand the financial levers around raising capital, the impact it makes on the business, the ROI, and then what that gets you and the next step. So my first piece of advice is like, yes, you need a sophisticated model. And yes, you need to have people around you who support you with skills you don't have, but that doesn't give you a pass for not learning it yourself and not understanding it. Because I just really think it's one reason women don't raise as much capital as men is because they're just not as sophisticated with the numbers. I know that's a generalization, but I really feel in my experience with people I mentor, it's really true. So with that, I really look at like building, what does it take? Luckily for Garden Society, we were able to start the company with very little capital because we started in the medical market. We were then able to scale. And now we've for example, we're going to go out for another round this summer. We've already built a new factory in Ohio. We understand exactly what it required financially in Ohio. So we understand as we build our factory in New Jersey, almost exactly what it's going to take because we're templatizing, but then you have to have margin for error. You have to really challenge your budgets and assumptions and make sure you can manage to a budget. So I really think it takes a lot of sophistication around your ability to budget, your ability to be realistic, and then looking at it's better always to raise more than you need. If you women come to me, I'm trying to raise 500,000 to do this. And I'm like, well, you really need 2 million because 500,000 is not going to get you more than a packaging order and 2 production runs at the end of the day. Right. And so I think that advice from Jeff about that 9-month window of really looking at that and backing it out and saying, this is where I need to get to be able to raise again. And so for me to get to here is going to require this much capital to get back. So I should either raise this much or I shouldn't do this, or I need to retool my model. I think it's harder to raise less money than it is to raise more money, because with less money, people really challenge if you're going to be successful or you're going to come back, you're going to run out of money faster and come back right away. So just my 2 cents.
Anyone else to add to that?
Yeah, I'd just add that a lot of the things that Aaron said are right. Is you're got to leave yourself with a lot of runway, but you also need to have your ability to shift a little bit, right? To cut on some expansion when things aren't going to go right. And it's not just, this is what I need for the next 9 months or 18 months. It's really, what am I going to do with the business at what stage? And how do I invest for the things that I actually need when I'm looking for an exit too, right? So you need to be able to say, not only am I doing the right things in HR, my policies and my technology and all the things that I need to manage to be able to show somebody later, but I tell my team, think now what we're doing, and 3 years out, these potential acquirers are going to be looking at all this data and how did we perform against them? It's just like what investors are going to do through the raise too, because they're going to become either board members, advisors, or just folks that you talk to once a quarter to let them know how things are going. You're going to have to be able to support what you did for a very long period of time. And so leave yourself some room on both sides, upside or downside, especially on your expansion plans.
Great.
I like to have the companies have milestones so that we can sort of monitor how things are going. And in terms of how much to raise, especially early on, I think it's good to look for points of traction or of achievement where you feel that capital, that value is being created, which then allows you to go to the next round and justify the next round. Because a conversation that we're not going to have time to talk about today is, how do you value those next rounds? So if you don't have milestones and tractions and things that you can point to where value has been created, that's very hard to do.
And Alan, you're right. I mean, there are lots of investors that will say, listen, I'll give you 500 now and I'll give you another 500 when you reach X in revenue or X in total addressable market usage, right? That's very common.
The one thing I think that's also important to add is not all capital is equal. And so specifically as it relates to valuation. So one thing I see a lot, and I was really intentional around, which at this point is proving to be in my favor, is that a lot of my peers in 2019 were going out for fundraising rounds at really, really high valuations because of the frothiness of the market. And also one's ego, right? As an entrepreneur, it's easy to think like, well, my company's worth this and my company is worth that. I got really, really great advice early on that said, you know, the deal terms and the devil in the details is more important than the valuation. Because what happened is a lot of people did these really crazy valuations, but then there was all this like minutia around warrants and clawback and down rounds and all this stuff that while the valuation might have been really sexy, now they're losing their companies, they're losing control, they cannot fundraise. I took a much lower valuation early on and built slow but sure. I did smaller rounds compared to a lot of my peers, but just went one foot in front of another and kept clean term sheets all the way through. And it was incredibly helpful now to get to this point where there's like, you know, there's no predatory behavior in my cap table. There's no predatory behavior in my term sheets. And so did I get as sexy evaluation as some of my peers? No, but do I have a really incredible investor base and a clean cap table? And am I sitting in a really strong position right now, considering the market collapse? Yes. So, I mean, I really just think, make sure in valuation, you understand the detail. And like we intentionally took a lower valuation to have a clean term sheet, like no warrants, no clawbacks. My lead investor actually didn't even require a board seat because what he said is, and it was incredible. So for all the investors out there, most rounds are led by white men, and I'm building a diverse company for underrepresented consumers and underrepresented brands. And they were really intentional around take a lower valuation. We're your capital partner for the long run, but we want you to build a board that best represents the company and provides the most value to the company. And we don't think we're that. So instead of us coming to the board, we would like to reserve those board seats for those board members when the time is right for the company that you're building for the future. And it was such a powerful statement to stand behind their values and also trust me as the founder. And then they also said to me, if you give a board seat to somebody else on this round, we're taking one. So remember that if you give it up to Joe Schmo, I'm coming in too. So therefore, I actually had leverage against anybody else in the round saying like, sorry, my lead's not taking a seat. We're not defining this board at this time. We're going to do that later. And we're going to have it be a diverse board that represents the diverse company that we're building. So it was a very powerful tool for me as an entrepreneur to take that lower valuation, but like have this incredibly clean organizational structure and cap table for moving forward into future rounds.
Jeff, if I can add one other point with all of this discussion is really interesting and valuable, but wanted to note too, because we're, as the law stands right now, cannabis, with the carve out, of course, for hemp and CBD, is illegal on the federal level. What state by state understanding is really important and valuable, in particular the new markets. And so understanding as you plan ahead and you're thinking through what investments you need for your future steps, where are those opportunities and those growth opportunities and when they may happen? And one thing that I know I regularly do is have sit downs with, especially certainly those that are in the pre-seed stage, where are the hot markets, where are the next markets, and how to be compliant within those markets, including when the next license drops and so forth may be. And that can help guide how much capital you'll ultimately need to obtain, as well as your plan, right, for the next step in terms of your future and anticipated successes.
Terrific. Listen, we are just about out of time. I've got so many more questions. So I'm gonna pick one, maybe just to get a quick answer. Then at the same time, each of you just give a final thought, if you would, so that then Jean can close us out. So the question is just about materials, right? There's one pagers and then there's decks. What do you like to receive? So maybe Elaine, you would say that, maybe you could answer, maybe Jeff, as you guide companies. I just typically would advise people, just do an investor deck, one that you can send around, one that doesn't have to stand behind an NDA, but that really tells your story, and get that so people have a feel. Other people think do the one-page executive summary, save the deck from where you're at the meeting or on the Zoom call. Just what are your thoughts, comment on that and then maybe give a final thought, and then we'll close out.
I'll jump in. So we generally collect 4 pieces of information to start, right? Either an executive summary or a deck, the current financials, usually 2 years back or since inception, whichever is shorter, the projections going out 3 to 5 years, and the cap table. If I start with that, I can pretty get a good assessment of where the company is heading and what the likelihood of success is. And then that's when we'll get into the data room. And after that, if
But what do you send to your investors that might fund when you're marketing?
So we will do a lot of work with people on their decks to put it into the voice that it needs to be into for the different sets of investors we have, right? So if we're going to a credit investor versus the VCs, you need to understand your audience and how to put that deck together. So we'll do a lot of work pre going out with that issuer to get that deck into the right voice.
And any other comments? Anyone else?
I mean, I think the mistake a lot of people make is they think a deck is static. And at the end of the day, your deck is a living thing. And through the fundraising process, you might have 30 versions of a deck. Because if you're presenting a 5-minute pitch competition versus you're sitting down with a sophisticated investor, you're going to show different things in that deck to engage that audience in different ways. So I have like a generic, like 10 slide, very traditional via Google, this is my deck. But then I like, it's, you know, I probably have like 100 versions honestly saved on my computer, because if I'm talking to Jeff at Arcview Capital versus like an unknown angel who knows nothing about the cannabis industry, it's a very different conversation. And that's a very different deck. And you have to do the work to sophisticate the conversation out of the gate so it's value added. If you just send a generic thing all the time, you'll probably lose half the fish you're trying to catch just because you didn't do your work up front.
And
So
anyone?
I asked for a deck, cap table, and a term sheet. And the term sheet, sometimes people say, well, we don't have a term sheet. Then I ask for what they expect to raise, what their valuation is, and any other conditions. And it's not necessarily because that's going to be where it comes out, but it's more like a sanity check. You know, if I meet somebody and they say, yeah, we're raising, you know, it's like early stage, we're raising 2 million at a $20 million valuation, you know, well, I'll say, well, you know, no, thank you. Go on to the next one, because I just don't want to waste my time.
I would just say, you raised a very important point, right? You have to work with somebody like Christina to make sure you have the safe note, the subscription doc, whatever it is, ready to go. I can't tell you how many times I've gotten somebody to the table and the documents weren't ready and the investor walked away because they're ready to sign a check, but they had nothing to sign. So that's crucial.
All right.
To Jeff's point, just to add my one quick add, Jeff, with multiple here, is that engage counsel early so that they know you're doing these, so that we can make sure we have them ready. The number of times I get a call and they need it tomorrow and the right person to get that to you isn't available is tough. So that's where having someone who you know you can call and knows what you're doing is really helpful. And they're part of your team, right? Just like everyone else is talking about their teams.
All right, great. So guess what?
One very important thought is, in today's world, today's economic environment, there is no such thing as too much capital. If you want to raise $1 million and you've got $1.5 million that's interested, take the money. Take all the money you can today. Don't worry about dilution. Don't worry about any of that. Take as much as you can, because you don't know when it's going to come back. So,
all right. On that note, take the money. And that's the right way to close. Jean, let me hand it up to you. Thank you everybody for joining, and Jean's going to close us out.
Love these thoughts, and Jeff, what a terrific job of creating a vibrant conversation. I really appreciate that, and I hope our audience appreciates that. I saw a lot of good comments. I thank you, Elaine, Aaron, and Bob, and Jeff Pascarella from Arcview Capital, and Christina. Terrific effort. I really thank you. Here's what I got from this conversation. I loved it when you, Aaron, and Jeff talked about the nomenclature around these various investment stages. I think that's important. Jeff P., I loved it when you talked about don't hold too tight to the valuation. I have seen that disease of dilutionitis so much. And obviously you have to. Those are really great words of wisdom. Bob, I loved it when you said that you paid attention to market valuations and made changes, and you also made changes in the form of your vehicle, just to meet the market. I think that's smart. I liked the discussion about metrics. Jeff Finkel, so important for people to understand how that is. And Elaine, for you to talk about the nuances as an experienced investor and share your pearls of wisdom. I like the discussion about NDAs because that's a tricky wicket. And to hear what you had to say, Aaron, about from a founder standpoint, how they can impede progress was good. Christina, your wise words about documenting. I have seen so many teams blow up for that very reason. So I want to thank our investors, our friends who joined us today of Arcview, and for our vibrant community. Now we're thrilled to tell you we've got a few upcoming in-person events. We've got save these dates. Next week, we're doing a Women's Inclusion Network live event in Los Angeles. That's Thursday, June 16th. You're welcome to join us still. There's still a chance. It's at Green Street, a fun, great venue. This is a one-day experience event. And then we are thrilled, I said this at the top of the order, that in October 19th in New York City, which is my city, October 19th, 20th, and 21st, Arcview is restarting its live events. We are thrilled to bring that to you. Thank you again for joining today. Really appreciate your engagement. Thank you.